If you want pure growth exposure to the biggest innovators in technology and consumer markets, QQQ is still one of the most powerful tools available. This is the Invesco QQQ Trust, the ETF that tracks the NASDAQ 100. As of late July 2026, it continues to deliver strong long-term returns, but it also carries real concentration and valuation risks. Today, I break down exactly what QQQ is, the clear bull case, the genuine risks, the latest performance numbers, how it stacks up against SPY and QQQM, and I will show you my own position results so you can see the real-world outcome. No fluff, just the facts. QQQ is a unit investment trust that seeks to track the NASDAQ 100 index. That index holds the 100 largest non-financial companies listed on the NASDAQ stock market. Unlike covered call income ETFs such as JEPI or JEPQ, QQQ has no options overlay. There is no strategy that sells calls to generate premium. It is pure equity exposure. You get the full upside and the full downside of those 100 stocks. The fund uses full replication, meaning it holds the actual stocks in the index in roughly the same weights. Expense ratio is 0.18%. Assets under management sit around $450 to $490 billion, making it one of the largest and most liquid ETFs in the world. The dividend yield is low, currently around 0.45%, because these are growth companies that reinvest rather than pay high dividends. Distributions are paid quarterly. This structure is deliberately simple. You are not collecting income. You are buying long-term capital appreciation driven by the dominant technology, communication services, and consumer companies in the NASDAQ 100. The bull case for QQQ is straightforward and powerful. It gives you concentrated exposure to the companies that have driven the majority of market gains over the last decade. Names like Nvidia, Apple, Microsoft, Amazon, Alphabet, and others sit at the top of the portfolio. These businesses dominate artificial intelligence, cloud computing, digital advertising, e-commerce, and consumer electronics. Historically, the NASDAQ 100 has outperformed the broader S&P 500 over long periods because innovation compounds. When technology spending accelerates or new platforms emerge, QQQ captures a larger share of that growth. Liquidity is exceptional, options markets are deep, and the fund is easy to trade in size. For investors who believe the next decade will continue to be led by software, semiconductors, and platform companies, QQQ remains one of the cleanest ways to express that view. It has delivered strong total returns for patient holders, and the structure is transparent with no complicated derivatives layer. If your goal is maximum growth exposure to the innovators, QQQ does the job efficiently. The risks are real and should not be ignored. Concentration is the biggest one. The top 10 holdings make up roughly 45 to 46% of the fund. A handful of mega-cap technology and semiconductor names drive most of the performance. If those companies stumble, the entire fund feels it immediately. Valuation risk is also elevated. The portfolio trades at a high price-to-earnings multiple relative to the broader market. Growth is already priced in. Any disappointment on earnings, capital spending, or regulation can trigger sharp drawdowns. QQQ has historically been more volatile than SPY, with larger peak-to-trough declines during market stress. Sector concentration in technology, currently around 60%, means the fund is not diversified across the economy. It will lag in value-led or defensive markets. And because there is no options income to cushion returns, every decline in the underlying stocks hits the net asset value directly. This is a growth vehicle, not a balanced or income-focused one. As of late July 2026, QQQ is up roughly 11 to 12% year to date and has delivered around 20 to 21% over the past 12 months, continuing to outpace the broader market in growth periods. Tech and semiconductor earnings remain a key driver of near-term moves. Compared with SPY, QQQ offers higher growth potential, but with greater volatility and lower dividend yield. SPY is broader, more diversified across sectors, and better suited for core holdings that need lower risk. QQQM tracks the exact same NASDAQ 100 index as QQQ, but charges a lower expense ratio of 0.15%. For long-term buy and hold investors, QQQM is usually the better choice on cost. QQQ remains preferred for active traders who need maximum liquidity and options volume. Here's my own QQQ position. I started buying on August 3rd, 2020. Net cash invested is about $2,656. Current value sits at $5,343. Total gain is $2,764. That works out to a money-weighted return of 203%. Dividends earned over the entire period total $77.51. The most recent dividend on July 10th was $6.44. Almost all of the gain has come from price appreciation. This position has been one of the strongest long-term growth contributors in my portfolio. QQQ is a pure growth engine built on the NASDAQ 100. It delivers concentrated exposure to the companies driving technology and innovation with no options overlay and minimal income. The bull case rests on continued leadership from those innovators. The risks are concentration, elevated valuations, and higher volatility than the broader market. SPY is better for diversified core exposure. QQQM is better for long-term holders who want the same stocks at a slightly lower cost. QQQ itself remains ideal when liquidity and trading flexibility matter. My own results since 2020 show what patient ownership of this fund can produce. Size it according to your risk tolerance, and remember, it is a growth tool, not a balanced or income solution. If this breakdown helped you, hit like, subscribe, and tell me in the comments whether you hold QQQ, QQQM, or neither. See you in the next one.